Hey, welcome to this session of Money and Capital Markets. So for this session, we're looking at equity markets. So looking at equity markets, that's our session focus today. Let's get straight into it. So what are equities? Before we get into the session, what are equity markets? Equity markets are simply the backbone of modern capital mobilization, because when you're mobilizing capital, you're looking at two types of markets, debt and equity. So now, our focus was on the equity market. Now, equity markets provide a platform where businesses can raise or generate long-term financing and where investors can build wealth. So in our case here, taking a deep dive into both the private and the public sector equity, as well as secondary offerings that some support. So now, our objectives of this session are we need to explain how stock markets facilitate secondary market trading and describe investor participation in stock markets, outline the process of IPOs, discuss first secondary offerings, and describe the globalization of stock markets. So, what is private equity? So now, when it comes to equity market, right? Equity markets can be defined as ventures. They can be defined as ventures where firms, ownership in firms, is issued and traded. Now, when it comes to equity, it serves two vital purposes. The first one being the primary market function, where companies raise fresh capital by issuing new shares, and the secondary market function, where investors trade previously issued shares to enable price discovery and liquidity. So now, in economics, equity markets simply support the efficient capital allocation by transferring funds from savers to firms with productive investment opportunities. So let's get into private equity. So when a firm is created, its founders typically invest their own money in a business. The founders may also invite some family or friends to invest equity in the business, right? This is called private equity because the business is privately held and the owners can't share their shares publicly. So now, in private equity, we discover ownership is held by a small group of investors, which are typically founders, friends, or family, and the shares are not publicly traded and is used in the early development stage of the firm's beginning before the firm can meet certain regulatory and market standards for public listing. Any questions there? Any questions?
No, it's clear.
Okay, lovely. So now, what are the key characteristics of equity? What are the key characteristics of equity? So equity can be built on the following features. Firstly, investors. Equity has a field of investors, right? Now, in private equity, the investors are usually founders and venture capitalists. Then the best of liquidity when it comes to private equity is quite low. And then the governance setup of private equities is close monitoring because it involves both seats. And then the risk in private equity is usually higher than public equity. However, it's also a high return to justify for the high risk. Now, what are the exit options of private equity? Exit options are through acquisition, are through buyback, as well as an IPO, into public offering. So that covers the segment about private equity. Now, let's get into venture capital. Venture capital. What is venture capital? What is venture capital? VC. Venture capital, right, is simply another form of private equity. It's funding provided to startups with high growth potential in exchange for equity. In exchange for equity. So it's funding that's given in exchange for equity. So in the investment cycle of venture capital, we look at it from screening and pitching. So firms in venture capital conferences, firms pitch their ideas at a venture capital conference or submit proposals. Secondly, is negotiation, where the terms are set in terms of amounts, governance rights, and reporting, then the monitoring to regular updates and board involvement, and the exit to an IPO or an acquisition, usually within a 5 to 10-year period. Now, a venture capitalists simply fill the funding gap for innovative but unproven businesses. Now let's get into the other segment of this, which is the public equity. Public equity. So the firm goes public. It issues its stock in the primary market, the exchange of cash. So going public has two effects in the firm. The first thing is that it changes the firm's ownership structure by increasing the number of owners. Secondly, it changes the firm's capital structure by increasing the equity investment in the firm, which will allow the firm to settle off some debt or to expand operations. Now, so in terms of public equity, we have certain stock market dynamics. Like for instance, the firms issue shares in primary markets and investors trade on secondary markets to increase liquidity and enable portfolio diversification. So now, here's an example. A company like Econet Wireless, they raised capital through the Zimbabwe Securities Exchange to expand 5G infrastructure. So existing shares trade daily, which will allow for price discovery and investor flexibility. So now, the equity market is generally a place where shares are traded. For instance, in Zambia, with the Lusaka Stock Exchange, or LUSA in our case. The Lusaka Stock Exchange, or LUSA in our case. Now, how do investors participate and what are the stock price dynamics? Any questions so far? Are we clear here?
Yes, sir, very clear.
All right, thank you. Okay. Investor participation and stock price dynamics. So when it comes to investments, you have two categories of investors. You have your institutional investors and you have your individual investors. So institutional can be your banks, your pension funds, your insurance companies, and so on and so forth. Whereas individual investors are private investors who often have a lower capital and lower market influence. So the behavioral insights here is that investors buy the stock, buy stock when it's undervalued because they perceive the intrinsic value, and they sell when it's overvalued, which creates a price equilibrium by way of supply and demand. So the efficient market hypothesis now suggests that all available information is reflected in the stock price. In the stock price. Okay, so we have an activity right here. We have an activity right here. Are you able to see it? Are you able to see it down here?
Yes, sir.
Okay, we're going to look at some together. So I'll say in question one says, what purpose do equity markets serve? What purpose do equity markets serve? Can you give it a try? What purpose do equity markets serve? What purpose do equity markets serve? So generally, equity markets serve the purpose of firstly, your capital formation. Capital formation. So companies are able to raise long-term capital by issuing new shares to investors, which will help fund expansion, innovation, and so on and so forth. Secondly, it will help in terms of liquidity. Serves the purpose of liquidity. So investors are able to buy and sell shares easily, which gives them confidence to invest since they can exit their positions when needed. Thirdly, the valuation aspect, valuation purpose. So share prices reflect the investors' perceptions of the company's future earnings. So the markets tend to provide a real-time valuation for the firms based on supply and demand. Based on supply and demand. Now, fourthly, equity markets serve purpose of ownership transfer. So they allow ownership in companies to be transferred between investors without affecting company operations. Any questions there? Questions?
No, it's clear.
Okay. So I'll come ask question 1. Question 2 says, explain what is meant by private equity. What is meant by private equity? Are you able to give it a try? Are you able to give it a try? What is private equity? In your own words, what we just covered so far. How would you define private equity?
Yes, I can give it a try. Just by the term itself, private equity, this refers to some sort of investments, investments funds that one can buy and manage or invest in private businesses. So it has to do with some sort of investment into private businesses.
Yes, it does actually. It does. Exactly that. So generally, private equity just looks at investments made in private companies. These are companies not listed in the stock exchange or they are not public. Exactly. So the key features of private companies that the source of funds comes from high net worth individuals mostly. So very few individuals or institutions. The involvement is that in this one, as an investor, you take up an active role, management and decision making, and time horizon is generally long term in nature. And then for private company to change public, there has to be an IPO issued there. Okay. So that's question 2. Now question 3 says, under what circumstances is a public offering of stock feasible? So for a public stock offering to be feasible, the following conditions have to be met. Firstly, you have to have a strong financial performance. So the firm has to have stable revenue and profitability to attract investors. Secondly, there has to be growth potential. So companies with clear expansion strategies and market opportunities are more attractive. Thirdly, the market conditions. So when you have favorable economic conditions, there's an increase in IPO success chances. Number 4, regulatory compliance. So the company needs to meet certain legal and disclosure requirements of the stock exchange. 4th, 5th, good governance. So a strong good governance, transparency, and personal management are essential for a company to issue out an IPO. And the need for capital. So if a company needs substantial capital for growth and acquisitions, going public might be the best option that we may have. So people opt for private equity over public because firstly, private equity tends to have less regulations in comparison to public equity. So it doesn't require the same level of disclosure or regulatory compliance as public markets. And secondly, the control aspect. So the founders often retain control in private equity, especially in the beginning stages of this particular venture. Then the long-term focus also. So as an investor, you're usually more patient and focus on long-term value creation rather than quarterly values, side of private equity. Then It's also because of the speed and flexibility. So in private, the deals can be negotiated more flexibly than in public offerings. Any questions so far? Any questions so far?
No, not from my end. It's okay.
Okay, Madam Basti, any questions? Okay, let's proceed. The last question says, explain how investors' decisions affect stock prices. So on the stock market, just like anything, information is currency. So investors' decisions can drive stock prices through the forces of demand and supply. So how? The buying pressure, firstly. So when many investors buy a stock due to the positive news, again, information asymmetry, it's the positive news and so on and so forth, the stock price may go up because demand will also increase in that particular scenario. Secondly, selling pressure. So if investors lose confidence in a particular stock, they may start selling, which will increase supply and push the price down overall. Now, the other reason behind this is market sentiment. So market sentiment, so it comes to investor psychology and speculation. Behavioral finance takes its key role in this case because it can amplify price movements as well as even go beyond what fundamentals justify themselves. And also because of macroeconomic factors, investors can affect stock prices. So decisions influenced by interest rates, the GDP, the inflation, as well as other geopolitical events can also affect the overall investor behavior, which will affect the market prices in the long run. So in essence, the stock prices reflect the value, the collective valuation and the investor expectation at any given time. Any questions so far on that part? Okay.
No, it's well covered.
All right. Thank you. All right. Now let's get to initial public offerings, IPOs. So an IPO, this is the first time of offering shares by a particular firm that's private to go public. So an IPO is commonly used not only to obtain new funding, but to offer some new founders and venture capitalists a way to cash out their investments. So the first sale of a company share public, an IPO. Now, what are the key steps in an IPO? What are the key steps in an IPO? How do you handle this particular scenario? So step one, you first engage an underwriter. You engage an underwriter. You engage an underwriter. So this is often a securities firm. Securities firm. Secondly, you prepare a prospectus. So this now includes you preparing your financials, your strategies, and your risk disclosures. Thirdly, you look at your roadshow and book building. So you're gauging your investor interest and setting prices, please. And then fourthly, you go on listing and trading. So the fourth thing that you do is you go on listing and trading. So shares start trading on the public exchange now. Are we okay so far? On the IPO process? Are we okay? On the IPO process, are we okay? Are we okay there?
Yes, sir.
Okay, so that just covers the process here in general. Now, what are the abuses that you may face in IPO? What other abuses may face in an IPO? So in an IPO market, the common abuses are, there are just three. So firstly, you may undergo spinning. What is spinning? This is why you allocate IPO shares to executives as a favor. You may undergo spinning, may face spinning. Or you allocate, as an underwriter, allocate shares from the IPO to corporate executives, which would now require help with speed stream. So there's a favor in this case, or the higher the speed stream is now case here. Second abuse is that it gets out laddering. So when you have substantial demand for an IPO, some brokers tend to engage in laddering. What does that mean? It just means that they artificially boost the first day prices. They artificially boost the first day prices. Now, this itself will help build an upward price momentum, because some investors will now be willing to participate to ensure that the broker will reserve some shares for the next hot IPO for them. Next face in this is excessive commissions, abuse, excessive commissions. So here, as a broker, you're charging high fees due to strong demand. Charging high fees due to strong demand. That covers the IPO segment. Now, let's look at our secondary stock offerings. So a secondary stock offering or secondary offering is a new stock offering by a particular firm whose stock is already public. So you declare out new stock by a already public firm. That's secondary offering. Now, in this case, you have firms with listed shares that are issuing additional shares to raise more capital. So this still would dilute fixed ownership and temporarily depress the stock price. And the firm's time offerings, so firms tend time offerings when market sentiment and share price are strong. Market sentiment and share price are strong. So the firm may monitor technical indicators as well as PE ratios and other conditions before launching secondary offering. Now, back from secondary offerings, you have what you call your stock repurchase. So the notion of information asymmetry means that the firm's managers have information about the firm's future prospects that is unknown by the firm's investors. So when firms believe that their stock is undervalued, they can use the firm's excess cash to purchase a portion of its shares in the market at a relatively low price based on their valuation of what the shares are really worth. So firms tend to purchase some of their own shares when share prices are at very low levels. So the reason behind a repurchase is that you're trying to signal undervaluation. So again, it comes back to the asymmetric information theory. Second, you're trying to boost your EPS, your earnings per share, and your share price. Third, you're trying to distribute the excess cash tax efficiently. Fourth, you're trying to reduce small shareholders to cut admin costs. And you're also trying to fund employee stock options. So a repurchase supports shareholder value if the internal valuation, the intrinsic value, exceeds the market value. That covers our stock repurchase option. So I have some questions here on the screen. Are you able to see the questions here? This activity here, are you able to see it?
Yes, yeah, it's visible.
You just take a screenshot of it, and then this is what we're looking at later on. So you can just look at this as your task, which I'm going to get back to and just review in our next session. This is our task I'm giving us here. You just look at this one right now. I'll post in the group shortly. But this is our task we'll be looking at, 7.2. Okay, so let's now proceed to the repurchase option. Let's now get briefly into the stock exchange now. When it comes to stock exchanges, right, your securities exchange market, they're usually in two forms. You have the organized exchange and you have the over-the-counter exchange. So now, how are these two different? So for starters, the organized exchange is an organized physical or electronic platform. So for instance, these are do say the NYSE, the NASDAQ, those are physical or electronic platforms of trading. And they have transparent pricing and strict regulation and governance. Now, the other one is over-the-counter market. So over-the-counter market is decentralized and mostly internet-based. For instance, the Facebook marketplace is an over-the-counter market. So the regulation here is quite reduced, but the flexibility is higher. And it's suitable for what you call smaller stocks, smaller or niche stocks. So now if you have to look at the comparison basis. Now, on the aspect of transparency, the organized exchange has a high transparency level, whereas the over-the-counter has a low transparency level. Liquidity on the organized exchange is high. In the OTC, over-the-counter, it's variable, can be high, can be low. Regulation in the organized exchange is strong. In the over-the-counter, it's weaker. Examples of organized exchange are things like your London Stock Exchange, your New York Stock Exchange, your LUSE, whereas your over-the-counter market examples are in the beginning, before it became organized, NASDAQ was initially an over-the-counter market. Are we okay there?
Come again, sir. Sorry, I missed the explanation.
So I was saying, over-the-counter markets are simply decentralized markets where there's less regulation and greater flexibility. And they're quite suitable for smaller stocks. Now, an example I gave was NASDAQ. Before it became organized, it was an over-the-counter market. Now, the organized markets are the ones where it's either physical or electronic. And the pricing here is transparent. And with that, there's strict regulation and strict governance. Are we okay so far?
Yes, sir.
Okay. Now, let's look at the next part on the globalization of stock markets. Globalization of stock markets. So for a stock market, you have integration trends. So firms tend to list internationally to diversify their investor base and to improve credibility. So the investors access the foreign markets for returns and for diversification also. Now, why does all this happen? The benefits of globalization is that it gives us enhanced liquidity, improved valuation, and international branding. But on the cons aspect, there are limitations. That the cost of compliance to foreign accounting standards is quite high, and the exposure to geopolitical and currency risk is also high. So, for example, the Zimbabwean firm listed on London Stock Exchange may attract institutional investors, but then it has to conform to the IFRS and the UK regulations. That's in our globalization. Now, our closing segment on the investing in emerging stock markets. Investing in emerging stock markets. So investing emerging stock markets are often small in nature. They're often small in nature. They're small, they're immature, and in most cases, they're actually volatile. They have what you call limited regulatory oversight, and the opportunities are due to mispricing or low PE ratios. Now, the risks of this is that you get to have insider trading because of the limited regulatory oversight. You still have political instability, and you have rumor-driven trading. So it's more like everything is based on speculation throughout. Rumor-driven trading. So equity markets themselves are fundamental to the financial systems because they enable firms to raise capital and investors to grow well. So from private equities to venture capitals to IPOs and so on and so forth, you find that they're all diverse and strategically important. So globalization now just offers extended expansion opportunities, while the emerging markets present both high risk and high reward. Now, having informed participation and regulation are a key for us to ensure that we have efficient, fair, and productive equity markets. Any questions so far? Any questions?
No questions. No questions.
Okay. All right. So I'm going to look at this question as our word cursor. This here is our word. We're going to look at this too. This activity on the screen here. So we're going to cover this activity too, along the way for today. So for now, we can wrap up here. Thank you for your time. Have a good afternoon.
Thank you so much, sir. We appreciate the recording.
Yes, be shared. Sure.
Even yesterday's, I don't know if it's ready for sharing.
Oh yes, they'll all be shared today.
Thank you so much.
All right, thank you.
All right.